Hi, Ed. Welcome to Venture with Grace today.
Hi, Grace. Good morning. It's good to be on.
Your cat is really cute. So in case the audience are curious, what is something behind you? But anyway, um to start the show, I would love for the audience to get to know you a little bit more. You have worked at multiple different funds such as Goodwater, Redpoint, and now you are a founder of your own fund, Alpine Ventures. And to give the audience a little bit of your background, do you want to start with how you got into venture and what you have learned before starting your own fund?
Yeah, totally. Happy to share more on my background. Yeah, I've spent most of my career on the venture side, but before doing that, I worked at a startup and with startups before that. Went to Stanford for undergrad, got 2 degrees in computer science, had some internships at some prominent tech companies, including Facebook back in 2008. So got to see some of the later stage, stuff around tech. Coming out of school, I started off in tech banking. So I worked at an investment bank based in Palo Alto doing tech M&A. So mostly working with some later stage startups, doing sell side M&A, so trying to help them get acquired by bigger companies. And then after that, I had the itch to do an earlier stage thing.
Mhm.
So I joined a pretty early stage startup called Stitcher in the consumer side. Stitcher was one of the best podcasting streaming apps.
Mhm.
It's one of the first to do that way back in the day before Spotify and everyone else did it. I joined as employee number 23, so really early. I was one of the first business hires at the company, so helped to run a lot of the different business functions while I was there, including finance, and helped scale that up for a couple of years. We sold that company to a big music streaming service out of Europe.
Mhm.
That was in 2013 or 14. And then I joined the VC side from there. So I've been doing venture for the last almost 11 years now. And my first foray into it was I joined a very established fund called Redpoint that you're probably familiar with.
Mhm.
Redpoint is, a very old school fund, been
Mhm.
around for I think 25 years at this
Mhm.
point. So
We
very,
recently also had a partner there came on our show as well.
yeah,
But yeah.
yeah, they're great. And so been around for multiple generations at this point. So I joined the early stage team and I focus mostly on consumer. So, there's one side of the firm that was very B2B focused, did a lot of enterprise software, SaaS, and that was a big part of the firm, companies like Snowflake, Stripe, Looker, things like that. I helped to spearhead some of their consumer efforts. So we looked at mainly marketplace companies and on-demand service companies. So did that for a couple of years. And then in 2015, I came across a pretty unique opportunity to join what at the time was an emerging manager, is now a pretty established fund as well, called Goodwater. Goodwater is, I believe, the largest at this point, largest consumer tech focused VC fund in the world. I
Mhm.
think 3 or 4 billion under management. I joined right as we were raising our first fund, so very very early on, and helped to deploy 4 different funds while I was there, including a growth fund. So helped to establish a growth practice. Became a multi-stage firm and had a really great time. So I was there for about 7 years. Initially, we were exclusively U.S. focused, so based in Silicon Valley, looking at mostly Series A and Series B deals in Silicon Valley. But as time went on, we really spread ourselves out and did a lot of deals across the world, including emerging markets like Southeast Asia, Latin America, Europe, um, and then uh, and then did more in the U.S. as well, and then across stages too. So did that for a while, and then in late 21, I had the itch to start my own thing. It's something I'd been thinking about for a while, and it was always a question of when, not if, I would do it. And I just felt more and more ready and just more and more compelled to start my own fund.
Mhm.
And one of the strategic things I wanted to do was to be really focused on early stage.
Mhm.
And what that meant for me was uh, focused on companies, not not necessarily at formation or inception, so not necessarily helping to start a business or ideate a business, but helping them put in the building blocks once they have an idea and a product, once a founder has an idea and a product, and helping put the building blocks in place to turn that into a company. So
Mhm.
thinking through a revenue model, helping with growth, helping with early hiring, all those things. And so I built a firm that was laser focused on that. So I started Alpine in 2022, so about a year and a half ago. I focused on everything from pre-seed to seed to Series A, although I'd say my sweet spot is much more at seed. So I call it the first post-launch or post-product round of a company. So right after they launch a product and they need capital to build a team around it and scale it up, that's typically when I come in.
Totally. I want to say hi to the audience. Hi, Steven. Anyway, so when you were thinking about starting your own fund, I guess we chat about data is one of like a biggest one of your specialties. And I wonder, how do you think of like data can help you spot deals that may be overlooked by other people? And I guess like in general, how do you build an edge for your own fund?
Mm-hmm. Yeah, data is a big part of my fund, and it's probably the core area of differentiation for my particular strategy. And it's something I've been doing for a while. So not a lot of people know this, but even when I was at Redpoint, I started experimenting with a bunch of different data products, building data platforms internally as a way to source deals. It works particularly well for consumer and prosumer companies, which are my big areas of focus. And I'd say there are a bunch of things I can say around it in a lot of different directions. But I'll say generally to start, I think a lot of data-oriented investing has been overlooked or ignored on the VC side. Especially early stage venture has traditionally been a very network-heavy business, right? Mm-hmm. It's about the classic way to do venture is you build a network with a set of founders, executives, other co-investors, people in a particular ecosystem. And that could be a location, it could be a company, it could be some kind of domain. And then, you source deals by getting referrals from people in that ecosystem. And that's worked really well for a while. And it continues to work. So, I think that system, is pretty robust and it does generate good deal flow. But just from like a simple math perspective, there's so many people that are outside of these really tight ecosystems mm-hmm. that are building great companies that aren't getting looks, that aren't getting attention, and that are being mm-hmm. largely ignored by by traditional VC firms, right? You just think about the math around there are like 7 or 8 billion people on the planet, right? Mm-hmm. Only maybe 8 million of them live in the San Francisco Bay Area, right? It's like a fraction of a percent. And yet, I read a statistic the other day that 25% of all the venture dollars in the US go to San Francisco-based companies, right? So there's an immense concentration in one particular geography. And that's at the expense of all these other people that don't have access to that capital and that resources. But at the same time, what's happened over the last decade is it's become easier and easier to start and build early stage startups. One from a cost perspective, cloud computing, the mobile ecosystem, a lot of the frameworks around infrastructure and development have made it really easy to get set up. And so, even if you're a single person with a laptop sitting in an emerging market, you don't have to have access to a ton of infrastructure or capital to start a company, right? You can build an app, you can launch it for free and start scaling it. And so a lot of people have started to do this. So there are more and more examples of companies and founders that don't have these pedigree backgrounds that we're used to, that are getting some early success. And so they'll build an app, they'll build some free product, it'll get some organic adoption. And then a lot of them will hit a wall where they'll get like some revenue, but then they don't know where to go from there, or they struggle with hiring, they struggle with, further scaling the business, or, transitioning the business model to something that's higher margin or things like that. And that's where a firm like myself can really come in and help a company to transition from some, little project that's doing well into a world-class business. And that's what I try to do. And data comes with that, in the sense of I use data to find those kinds of companies, because a lot of those founders are out of network. And so they're not people that would ordinarily be referred to me. So I use data signals in order to find the products themselves that are getting some growth or getting some engagement.
Totally. I wonder, recently there's a lot of data related AI app that's helping people spotting different deals. For example, let's say a company would help, if let's say a person out of maybe not your strategy as like geographic location that's not San Francisco, maybe they will just be like, oh, Google core employee leave Google and then they started like a LLC somewhere, and then instead of like knowing what they do, maybe people just track down data like this to, spot the stealth mode, high potential company. So I wonder, like, when you are thinking about data to collect, what are some kind of signals that you use to, um, like, what are things that you would focus on to spot the um, quote unquote invisible deals?
Hmm. Yeah, I focus a lot on product signals. So,
Mhm.
there's different, and there are a few other data firms that focus on slightly different things. If they focus on, maybe a different stage, more B2B, for example, or deep tech. But for me, given I focus mostly on bottoms up PLG driven businesses, product led growth. So, these tend to be either pure consumer or prosumer, or SMB type of businesses. They tend to exhibit a lot of, I would say, a signal around user growth and user engagement are the main things. So signal around, how many new users they're getting, how that's accelerating, and then the engagement of that user base in terms of, time spent, sessions, overall retention, those kinds of things. Those are the primary signals I look for. And then there's a lot of other added signals or derivatives on top of that in terms of acceleration, or signals around market or competitive intelligence, those kinds of things. So there's a whole slew of things, but I'd say top line, looking for early products that don't have a lot of funding, but that are getting some kind of superlative growth or some superlative engagement early on.
Mm.
Mhm.
So early products don't have a lot of funding. So like what when you're finding these products, I guess where do you use to find them? And then what kind of product in specific that you feel like are gonna generate high return?
Mhm. Yeah. So a big part of the challenge around building a data system is, one, knowing where to start in terms of what companies to track, right, and how to find
Mhm,
them, right? Because it's a slightly, I would say, different problem. There's one problem in being able to get signal
mhm,
from the underlying data, right? Being able to tell, okay, what's a false positive, what's better than everything else, how to benchmark stuff. So that's a whole set of challenges. But even before that, one of the biggest things that a lot of firms that try to build data systems really struggle with is just understanding, okay, what should I track in the first place, right? Like, how do I
mhm,
know what all the pre-seed or seed stage startups are? There's no universal database, right? There's some
mhm,
fractions of it, like Crunchbase has some of that, PitchBook has some of it. Um, and so, for me, I take a pretty, there isn't really one universal way. It's a combination of a bunch of different sources and then unifying them together. So like I'll look at some of the known startup databases as, as one source. So
mhm,
sources like Crunchbase, like PitchBook, like Product Hunt, etc. But then also look at a lot of raw product listings too. So, for example, um, I try to track most of the App Store, so both Android
mhm,
and Android and iOS global app stores. I track a
mhm,
really broad set of web domains. So, like basically any website that has some, meaningful material amount of traffic, I'll
mhm,
try to find those and track those, regardless of whether it's a known startup or not. And then there are a bunch of heuristics I'll do to try to determine whether that's a tech startup and how much funding they've raised and things like that.
mhm.
So yeah, it's not perfect by any means, but I try to build up as a comprehensive database as possible of all of the potential investable early stage startups out there.
Mm. I wonder when you're tracking, would you say you track, let's say, how many people download, or like what are the signals that you would think like actually matters? Because
Hmm.
also there's some like false data. So
Yeah.
let's say if people trying to hack the app store, or like even like I want to call it hack, but like for any of my friends who is trying to launch on product hunt, even just random people that are like maybe third degree connection, they're trying to launch on product hunt, they would message you to be like, hey, please Apple us. Like I don't even know what their product is, but like I guess like there's a lot of like signals that could be wrong. So I guess like how do you kind of filter out the inefficient data? Also,
Mhm.
hi Oscar. Just saying hi to the audience. But
Yeah,
anyway, keep
totally.
going. Yeah.
Yeah, you're right. There's a lot of false positive and a lot of false
Mhm.
signal. So it's certainly not as easy as, I've met some VCs that try to do something really simple, like they'll look
Mhm.
at app rankings and,
Mhm.
or maybe downloads, like you're suggesting, if they have a subscription to App Annie or Sensor Tower or something. And they'll just look at, okay, what new apps are top ranked, right? So they'll go
Mhm.
into like the finance category and be like, oh, there's a top 20 app that's new.
Mhm.
Um, and on one hand it does provide some signal, right? Like to get
Mhm.
an app into a top ranking and a top chart in a big market, especially like the US, it takes a lot of downloads. Like it takes a pretty high degree of distribution to get there.
Mhm.
But they tend to be false positives, right? And so
Mhm.
there are a bunch of ways you can try to filter those out. One is just like the time element of it, right?
Mhm.
uh, Most things that rise up in the rankings tend to only do that for a day or two, and then they'll quickly die off.
Mhm.
So even if you wait like a couple of days, there will generally be a big fall off. Versus if something
Mhm.
continues to grow or continues to maintain, that's a better
Mhm.
sign. But then there are a lot of other things you can do to derive whether that's quality growth or not. Right. So it's not just growth for the sake of growth, but quality. And so there's a bunch of secondary signals you can look at. So for apps specifically, as an example, there are things you can do around looking at review volume and quality.
Mhm.
That's a much better indicator of whether an app has real usage or not. So
Mhm.
like if you see an app that has 100,000 downloads, but they only get 5 reviews and they're all bad reviews, that's probably a really
Mhm.
bad sign, right? That's all just paid for. It's they kind of hacked their way into there. Versus if they're getting tens of thousands of reviews and they're all 5 star
Mhm.
and they're all like real reviews, the
Mhm.
text is pretty meaty. That's a much better sign. You can look for also secondary signal to uh, you can look for secondary signal that would further qualify that initial thing. So, for example, if there's a mobile app that also has a lot of web traffic and then also has a ton of Instagram followers and also has a ton of YouTube, viewers, like there's multiple channels where they've been really successful for a period of time, that's a really good sign. That means that there's something that's, that's growing. You can look at like organic community mentions. So, one of the first things I'll do if I hear about a company is I'll look it up on Reddit and see how many Reddit posts there are about it and like what people say about it on Reddit. And
Mhm.
generally, there's a correlation between like just volume of mentions there and not, whatnot. And it's a lot harder to hack Reddit because you need different users to actually talk about it and stuff like that. So those are just some of the things, but there's a lot of other stuff that you can do to really qualify the growth of a company.
Mm. I wonder, what are, let's say, like, is there any specific benchmark of the like numbers that you would use for each category of things? And how do you find like, because I'm sure like you are investing in like look just by looking at like, things that you have invested in, they're not in the same sector. So there is fintech, there
Yeah.
is, other
Yeah.
sectors. So I wonder how do you benchmark different things to um I guess like get the best out of each category. And I'm sure you can benchmark them with either a successful app in the category or similar app in the category. But I wonder like
Yeah.
what are some prediction like what are some like I'm sure like I don't know if like the number is the highest would eventually end up to be the category king, as I've heard of investors who have invested in Facebook because they couldn't get into MySpace, but Facebook ended up to be a really amazing outcome. So I wonder how do you kind of like benchmark different category of things? Also, how do you select the winner?
Yeah. Yeah, it's a really funny anecdote because I know investors have done the opposite too. Like they invested in MySpace because they couldn't get into Facebook, and
Hmm.
that was a much worse return. So,
Hmm.
yeah, yeah, markets do change a lot. So On the benchmarking side, what I'll say, I think you touched on a lot of the things correctly. Like one is, I'm not trying to build a universal model for like the perfect startup. Every startup's different and
Mhm,
every industry is different too, right? So,
mhm,
one thing I've done is I've segmented
mhm,
different categories. So internally, I track about a dozen different categories that
mhm,
are very specific. So like consumer fintech is one, consumer education is another. They largely track like verticals, industry verticals. Health and wellness is another one, social gaming, productivity tools. There's like six, there's like 12 of them. And so, at a high level, I try to be very categorical about like which companies fall into which category um, and which metrics are more pertinent to a specific category, right? So if you're evaluating a media company, for example, like the
mhm,
next Spotify or the next Netflix, minutes spent, like actual time spent in the app per user is a very relevant metric, right? Like literally how
mhm,
many minutes are people spending? That's directly correlated to usage and engagement. But for something like fintech, it's not necessarily time, right? Because you don't need to
mhm,
spend a lot of time with like a payment app or a banking app. You might get the transaction done really quickly. So that's a much more nuanced thing. It's more around like regularity of sessions, right? If you use the product once a week, but you open it every week and it's with regularity, that's a good
mhm,
signal. If you can track actual payment dollars, going through the product, that's a really good signal too. So depending on the category, there are different metrics I'll look at or weight as well. And then, like you said, within each category, I have some historical data about successful companies from the past. So, in fintech, for example, all the neobanking apps, I have historical data for how they grew at an early stage at seed, Series A, companies like Robinhood, et cetera, as
mhm,
well. And so when something new comes along, I can actually benchmark it head to head against those historical examples. Or if it's a new social app, I can benchmark it against Snapchat when it
mhm,
first launched, or Instagram, or TikTok, Musically, those kinds of things. And so you can actually tell if something's growing faster or has better metrics, than those companies did at that time. But it's not like about one specific thing. It's, every company, like, is pretty nuanced. So,
mhm,
it's not as simple as I'm just looking for the highest number of this, and that's the investment I'm going to make.
mhm,
It's just more, it helps to frame how special a company is. And helps me, find things that I otherwise might have overlooked if it has
mhm.
some number that's really strong. So it's more for qualification and discovery, but it's not so much like, strictly I'm going to invest based on one number, right? Or two numbers or things like that.
Mm. Um, I wonder, like, so what are some ways to, like, I guess, like, how do you evaluate your own portfolio after you invest in them? Like, do you still study, like say, like benchmark them with category competitors, or like how do you kind of like leverage the data related tool to like kind of like help the portfolio grow?
Mhm. Yeah, that's one thing that I do help a good number of portfolio companies with. So I provide subsets of the data snapshots for free.
Mhm,
So, one very obvious thing is helping them track their competitors alongside
mhm,
them. So, if they are like a prosumer tool,
mhm,
and they have five direct competitors, I'll send them a monthly report on how their web metrics are tracking,
mhm,
how their if they're on mobile, their mobile metrics are tracking, social. So some of the the data points that I track,
mhm,
and just like how they're comparing against existing competitors, or if a new competitor comes along that just launched, like how that one is
mhm,
growing too. So that's something I've done for companies, even ones I haven't backed. Sometimes I'll send these snapshot reports just to help them out. So that helps a lot. And then, obviously also from a follow-on perspective decision, it can help too, right? And when
mhm,
I'm evaluating the series A, the series B, the next couple rounds, it helps to also helps inform that decision on whether this company is really outperforming, right, in their category versus
mhm.
others.
I wonder when so when you are thinking about your own fund, based on, you have worked at Goodwater, which when you joined, they were an emerging manager. Now they're pretty big. They're $1 billion fund. And I wonder, when you're observing, or like by working there, how do you think like they have been growing so fast? And I wonder also, based on right now, we have AI as a um, like AI is booming, and then there's a lot of tools and resources we could um, leverage to build our own like data benchmark, maybe not as sophisticated as yours. I wonder, what's your thought process on, like, um, number one, for yourself, like building out an advantage in the AI data space, and like number two is like, as a regular investor, I saw that like some audience asked about like tracking public company, or like, what are some tools that you recommend for people to overall leveraging AI to track certain company that's maybe not as sophisticated as how you do it, but like more in the general sense of how their portfolio have been performing.
Mhm. Yeah. Yes, on the data side, you're right in that it's important to keep pushing the boundaries to ensure that a firm like mine has a competitive advantage that sustains, right? Because like,
Mhm,
things move fast, technologies move fast, data sources can quickly get commoditized, and new ones are
mhm,
coming out too. So, part of my effort and what I put a lot of time and care into is making sure that I'm continuing to iterate on the data platform. It's not just a
mhm,
static thing. It's constantly iterating on its own with
mhm,
market feedback, but then also just constantly evaluating new data sources, right, and incorporating them in. I also think that there's an advantage in not just the data itself and the underlying like technology and infrastructure part of it, but it takes a lot for a firm to really dedicate their sourcing efforts to a data-driven approach. It's a very different thing, right? It's a little bit more hard work. It's a little bit more bland. It's a little more boring. And this is, I think, one reason why a lot of incumbent firms have struggled with this is because it just goes against so much of what traditional VC is, right? A lot of
mhm,
people pride themselves on their network and like who
mhm,
they know, and makes them feel important. And so, this is kind of like going against that, right? To say, I'm going to use data to find founders that I don't know, right? Or I
mhm,
need to be comfortable talking to founders that I don't know very well, that are maybe harder to reference, a little bit more risky. But, there's something interesting about what they're doing, and they're much scrappier, and it's like a more interesting opportunity. So I think, culturally, it takes a lot to really buy into that too.
mhm,
Um, you mentioned the public stuff. Yeah, I don't do public investing, obviously
mhm,
being a venture firm. And I don't apply a lot of, I don't do a lot of personal public investing either. I'm pretty passive on that front.
mhm,
Although I know a lot of folks at, different firms, whether they're crossover firms or much more deeper on the quant trading side.
mhm,
And, there are pretty sophisticated strategies around how to do it. I'll say it's a lot harder on the public side. On one
mhm,
hand, data sources are richer, but they're more, they've been much more tapped. So I think it's harder and harder to get alpha from,
mhm,
from data itself. Um, so it's hard for me to opine on that. I'll just say, there's a lot of, for people who don't want to build or don't have the means to build their own infrastructure, there are a lot of third-party tools that are pretty good at just tracking, high-level data points and a good universe of companies. So like on the mobile side, App Annie and Sensor Tower are pretty good for tracking mobile apps. SimilarWeb, Compete. There's some things on the website as well. And they're fairly good about tracking things. There's some newer tools that are more VC oriented. Like there's one called Harmonic that's pretty popular.
mhm,
That's more about people tracking. So they're tracking. It's more founder background specific. So they'll track like ex Stripe employees who've just started a stealth company and things like that. So it's pretty good for more pre-seed, pre-seed stage companies and things like that. So there's a lot of stuff out there. It's just you just have to have a willingness to use it regularly, and pay for it. A lot of data sources
mhm.
have a cost to them, so there's that too.
I wonder, when you are so like, I want to switch gear a little bit. So you have successfully transformed yourself from working at a fund to angel investing to building your own fund. I wonder, before you started or your own fund, how do you strategically, invest in like different things to kind of like proven out your concept before fundraising? And then I wonder, can you share a little bit more about like how you kind of raised your first fund?
Hmm. Yeah, totally. Yeah, I did a little bit of angel investing in between leaving Goodwater and doing a first close of my fund.
Mhm.
So I did do a few small angel checks. Honestly, it was less about proving the strategy and building a track record as it was. I just love investing and helping founders, and I just um, it pained me to be out of the game, so to speak, and out of the
Mhm.
market. So I just wanted to stay active. Like that was the main reason I did it.
Mhm.
It wasn't, I felt like I had a pretty good track record already from
Mhm.
the institutional venture experience I had, and I'd
Mhm.
already started to prove the strategy worked. I'd been applying it at slightly later stage, but still kind of doing similar things.
Mhm.
So it was less about that. It was much more, I just, love helping founders and didn't want to stop doing that for a year. So that was kind of what the angel stuff was. I've toned it down a lot. Actually, I've stopped it completely since, deploying this fund. One, because it's a conflict, and then two, I just want to be really focused on the fund. Yeah, and the fund. I can't speak too much about the mechanics of the raise itself. I'm under some restrictions around it, but also just speak generally about fundraising for emerging managers. As you know, 2022 to now has been a pretty hard market
Mhm.
for all venture funds, but in particular emerging manager raises. That being said, I think the quality of LPs on average has gone up, much like the quality of firms. And what I mean by that is, in like during the boom period in 21,
Mhm.
I feel like there were a lot of these, much like there were tourist VC investors, there were a lot of tourist LPs as well. So,
Mhm.
people who didn't understand venture, who hadn't had a history of backing venture firms, but they just got really excited by tech and the returns and all the stuff that was happening. And so you saw a lot of these new entrants come in, whether they were, family offices that hadn't done VC before, or corporates that, hadn't formally done fund investing before, start to make some of these investments, or even other venture firms. There's some, I won't name them, but there are at least one or two very prominent large funds that backed a bunch of emerging managers, and they've stopped
Mhm.
that completely now. So,
Mhm.
I think there's a lot of pain that's happened from that LP group leaving. But overall, I think that's good for the ecosystem, because the remaining LPs that I've spoken with and gotten in the fund are very experienced with venture and very committed to it for the long
Mhm.
run. Like they're very even keel. They didn't overinvest during 21, and they're pretty active now too. So I think those types of LPs will continue to be really steady,
Mhm.
continue to be really, really active. The bar is very high. Don't get me wrong. The bar is really high,
Mhm.
especially to, be a new manager entering a venture program.
Mhm.
But, I'd say I've been impressed by the quality of LPs I've met, and it's been a lot of fun learning from them.
When you are thinking, how do you kind of quickly educate yourself on how to manage a fund? Because I'm sure you had a lot of experience in investing or building up the data infrastructure at Goodwater or Redpoint, but managing your own fund is a very different game. There is portfolio construction, there is
Mhm.
like trying to fundraise, like even just meeting LPs.
Yeah.
Um, how do you kind of like quickly educate yourself in the space?
Yeah. I just did it on the fly. I don't know what else to say. No, I mean, even before I started, I spent a lot of time talking with other emerging managers. I mean, I'm sure that's obvious. A lot of people do that, but I really did. I spent, like, even before I put together a deck. I think I spent, I don't remember, 3 months, like 2 or 3 months, where
Mhm.
I just did nothing but meet other emerging managers. People who are a little ahead of me had just raised their first fund or their second fund or the third fund, and just ask them everything I could ask about how to get started, how they got started, how they're building a portfolio, how they think about every little thing. I just came up with like a long list of questions and just asked a
Mhm.
whole bunch of people.
Mm.
Um,
What would be things on your list to ask people?
Yeah, I mean, there's a whole set of things around fundraising itself, like the tactics of it. How do you get
Mhm,
introduced to LPs? How do you qualify them? What do you ask in a first meeting? What do you prepare? What goes in your deck? What goes in your data room? How do you talk about track record? How do you prepare references? How do you follow up? Like, so there's, a lot of tactical things. What do they look for? I got a lot of feedback on my deck and strategy
mhm,
and that kind of stuff too. And then there's like everything post fundraising, actually deploying and then managing the fund, right? So
mhm,
I asked a lot of questions around portfolio construction, and different managers will say different things, right? Some
mhm,
are much more concentrated, some are much more diversified. There's a whole debate around how much reserves you should have, and there isn't a clear
mhm,
answer. Some have a ton of reserves, some have no reserves. And then portfolio construction wise, how many companies is the right, thing, pacing, how many years you should take. And then, LP management too, right? Like how often do you update them? How do you keep them in the loop? How proactive, what should you update them on? How do you report on these different things? So like all the stuff that was new to me, which was less on the investing side and, and working with companies. I felt like I, had done that for a long time, but just all the other kind of, oh, and then there's a ton of stuff around back office, right? Which fund admin to get, how to qualify a fund admin, how to work with them, right? Like what banking
mhm,
partners, what other infrastructure do you need? There were a ton of things I had to figure out on that side.
mhm,
Fortunately, I think nowadays it's a lot easier than probably it was 10 or 15 years ago when that stuff wasn't very built out. Like there's a lot of now resources and service providers for emerging managers that are much easier to work with and probably more cost effective than there have been.
mhm,
But yeah, I won't ramble too much, but that it was a lot of stuff around that, and just getting feedback from other managers, honestly,
mhm.
is the best way to learn, I think.
How do you kind of like motivate people to help you? Obviously, there is some goodwill in the ecosystem, but like,
Hmm.
people's job is running their own fund. And
Yeah.
like I also heard feedback from um people that like, uh let's say if people helping other like so basically people that are like couple steps ahead of certain emerging managers, they probably besides like building some friendship in the ecosystem, it's really hard for them to gain something from
Hmm.
people that are like earlier stage in their fundraising journey. And I wonder, how do you kind of motivate people to help you? And also like at this point, like have you ever doubted yourself on like, oh, maybe this is like too difficult, or how do you kind of keep yourself going or decide like this is the right thing for you?
Yeah. Yeah. I'll answer both of those in sequence. So, on the motivating side, yeah, I don't know. I didn't ever really think about it that way. Fortunately, maybe I'm just lucky. Almost all the people I know are just really helpful and have a very like pay it forward kind of attitude. And I think that's generally true of at least the emerging manager ecosystem. Is people are like, generally helpful. We're all in the same boat together. So I found at least most people I talk with have been pretty open about, sharing feedback on LPs, sharing lists of LPs, making intros where relevant, helping with deal flow. One way as an emerging manager you can always help another firm is helping with deal flow. So helping with referrals, shooting over potential deals to them, right? So even if you're maybe earlier on in a fundraising process, you still know founders and meet founders. So there's a lot you can, do to help on that front. Um, and then it's, a lot of like quid pro quo too. So
Mhm,
as I speak with, LPs on my end, I make a effort to try to, at least for the ones that I resonate with, or maybe even if it's not a fit, think about other emerging managers I know that could be a fit for them, right?
mhm,
And make that, and make that intro. So that I think builds a lot of goodwill. And then the other thing I'd say is more established VCs can also be really helpful too. So I was really lucky where there was one firm in particular. I won't name them. They're a little bit they're a little bit discreet,
mhm,
but their individual partners are LPs in my fund. They've known me for a long time. They're very established and really good. Like they're one of their funds is one of the best performing VC funds ever. And they were really helpful to me in helping me find more institutional LPs and putting in a good word. So, to the extent someone knows or has mentors that are more established, that can help a lot too. And they generally have more credibility with LPs too, right? Because especially if they've been successful, the institutional LPs will listen to them more and they'll command more respect. So that's important too, if folks have that.
How do you build a relationship with them? Let's say, like, I'm sure, like, I feel like in the venture ecosystem, people could meet each other at a superficial level multiple times, but how do you kind of um like resume the relationship,
Mhm.
especially after, let's say, Goodwater or Redpoint, because I feel like it's easier to brand build or like share deals when like working at a bigger firm. But I guess like when you are a spin out, like going out on your own, it's like I don't know if it's harder to build a relationship or harder to maintain a relationship, but just
Yeah.
curious your thought on that journey.
Yeah, yeah. Yeah, honestly, it's harder to do it from scratch once you're raising. So,
Mhm.
um, I think this is another thing about about starting a venture firm that took me some time to appreciate, but it really is a long game, and it's very different from startup fundraising in that, with startups, you could meet a new VC one day and then get a term sheet in 2 weeks, and like that's totally normal, right? Maybe a little less normal now, but like it's totally fine to meet a stranger and then get a check from them in a relatively short period of time when you're fundraising. It's not at all like that for LPs, and I'd say the vast majority of LPs want to have known you for a period of time beforehand. It could be years, but minimum, I don't know, 6 to 12 months or so. And I think this is true even of individuals. So, this is like for people who are thinking about starting a fund or launching a fund. I'd say it's a lot easier to be successful with your first fund if you've done some prep work and laid the groundwork in advance of doing that, where you start meeting prospective LPs, start building some relationships. It could be even years in advance, and that just helps a lot. Where once those relationships are built, you've maybe done co-investments, I don't know, you've helped them out in other ways. It's a lot easier then to go to them when you're raising and say, hey, like I now need your help doing this, right? And they'll be much more proactive about and willing to do it. It's a lot harder to go to a stranger when you're starting to raise a fund and then
Mm.
expect them to come in. I don't usually see that really effective. So I think it's just important to leverage existing relationships you have. And don't be shy about asking for intros to people that they know too. So I'd say like the first second degree network is really important for a fundraise.
Mm. I feel like the asking for intro part, I feel like it's also kind of hard because it's your social capital is gonna drain out at some point. You
Yeah.
want to kind of shoot the shots when you're already kind of um like very, very prepared at the last stage or something. I wonder, I guess like from when you're let's say in the middle of like I guess like there's like a 7 month grace period before you started a fund to from like your quit your old job to starting a fund, right? So let's say the 7 month, how would you structure the 7 month, and then what are things that you would do in each stage of the 7 months? Let's say like the first 2 months you want to meet as many emerging managers as possible. The second 2 months you're putting together a deck and then getting people's like feedback on the deck, and the last 2 months you're pitching like I don't know 200 LP or something. Like I wonder how do you kind of like process this whole journey. Also 7 months is very, very short in
Mhm.
terms of like raising your first fund. So I wonder how do you kind of like structure your time to like, shortening this process.
Yeah. Like again, I'll talk kind of generally, not
Mhm.
specifically. Well,
Yeah.
first of all, it'll probably take longer unless
Mhm.
you have a really strong LP base from the get go. It's going to take. I think the median amount of time to raise a first fund for an emerging manager is like 18 months. So
Mhm.
it could take, and in this market, it probably takes even longer. It could take 2 years. So, one, expect it'll take a really long time. So, be prepared to, like, financially, for example, support yourself, right, for that
Mhm.
period of time. I think that's really important. Um, yeah, I don't think it's as, like, my advice would not be to be too rigorous about, okay, I'm going to spend exactly this many months doing X, Y, and Z.
Mhm.
But try to do a lot in parallel. So, while you're meeting emerging managers, just getting, feedback on things, also be preparing a deck in the background, or, a doc and a deck maybe together. And then you're right in that on the actual LP side. So getting, a formal meeting with a prospective LP, especially if they're institutional, and then, going to them. It is better generally, if you don't know them already, to
Mhm.
approach them um, when you are more buttoned up, right? So when
Mhm.
you have, your story really well together, your deck is kind of put together, and first impressions are really important, right? So you want to come across as you know what you're doing and you know what your fund is. Versus, I think what's can set a bad impression is if you meet a pretty high profile institutional LP and you're like wishy-washy on a lot of things, right? Like, oh, I don't know how big the fund's going to be. I don't really know like these parts. Like, I'm just still figuring it out. Like, you want to have that figured out by that conversation, right?
Mm.
So that stuff you can hold off probably a little more. Again, it's a little different, I think, if you're friendly with them, like if they've known you for a while and you're more casual, then you can go
Mhm.
to them for more iterative feedback in the meantime. But it's, there comes a point at which you got to kind of delineate, okay, now I'm like formally ready to pitch and start raising the fund, and that should be more buttoned up. But even that process can take a while. The other thing I'll say is, it's I think there's trade-offs to doing a quick first close or not. I've seen, funds do different or have different styles there. But like, if it's really important to you to get started on getting fees and start investing and start deploying, you don't have to raise the whole fund right away, right? You can do a first close with, even as little as a quarter of the target, or, even like 10% of the target, and then start deploying it and then building the portfolio while you raise the rest in parallel. So a lot of firms do that, especially nowadays as the cycle is elongated. So that's another thing tactically that you can do to not, so you don't have to go 2 years without paying yourself anything and not doing any deals. You could do some of that in the meantime.
Mm. I have a couple questions there. Number one is like, how do you formulate what you've been doing into like a formal pitch? Because I feel like one of the like by like just chatting with fund managers, I feel like a lot of people have really interesting strategies, but people's strategy kind of change when they actually start investing,
Mhm.
and when they uh actually started deploying capital, people's like fund construction also change
Yeah.
throughout time.
Yeah.
So I've heard feedback from LPs saying like sometimes they invest in certain people because of they are really good at like following through on what they were set out doing.
Mhm.
And I wonder what's your thought on like formulating what you're already doing into an actual pitch.
Yeah. Yeah, I guess there's two parts to what you're asking. One is the, like, what you're doing, if I'm hearing you right, what you're doing before you raise the fund and how that translates to your strategy. And then if you're raising a fund and deploying, how do you like maintain that strategy if the
Yeah,
sizing
or
changes?
do you maintain the
Or
strategy?
yeah, or can you maintain this? Yeah,
Yeah.
yeah. So there's two different nuances there. Yeah. So on the first side, like, yeah, ideally, you should be able to tie your background to the strategy of the fund, right?
Mhm.
So, so like very specifically, if you have a specific sector of experience, and you're investing in that sector, it makes a lot of sense. Doesn't make
Mhm.
sense if you're not, right? Like if you were a fintech founder and you want to start a clean tech fund, like that doesn't really make sense.
Yeah.
Also, it's hard to translate, if you're only doing growth stage investing and then now all of a sudden you want to do pre-seed, that's also kind of a weird thing. Ideally, there's some alignment, or it's not too big of a shift where, like, if you're doing series A's, for example, and then you want to do seed,
Mhm.
that's a little bit of an easier transition because they're stylistically a little bit more similar. And so, on one hand, you do want to be able to show that transition. And if there's a gap, that's when you can actually do something in between to
Mhm.
help bridge that gap. So this is actually where like angel investing can help. So like, for example, if you were let's say you were like, I don't know, multi-stage investor and you want to do a pre-seed fund, but you never did pre-seed deals, you could spend like 6 months of that time period doing pre-seed deals, showing you can do those deals, you can get access, you can find
Mhm.
good founders, like build a mini portfolio there. And that's sort of like a track record of like showing that strategy and process, right? So you
Mhm.
can do it in between when you raise the funds. That's a good way to do that. And then on the second point, your point around the fundraise. So this is the big risk with doing a first close or like
Mhm.
a smaller first close and then trying to raise the rest of the fund. Because there's a lot of risk in not knowing your final fund size, right? So some
Mhm.
emerging managers, I've seen do get caught up in this where they'll think they're going to raise X. They do a first close with some very small fraction of X,
Mhm.
and then they're kind of stuck. And even worse, they start investing as if they're going to raise X, but like so the initial checks are really large relative to what the final fund size is. So the kind of the safest way to mitigate that is you probably heard the term minimum viable fund size. Like, what's the
Mhm.
absolute minimum that you need to like build a portfolio you want with like the
Mhm.
smallest possible checks,
Mhm.
right? So like if you ideally want to write 500K checks at seed, for example, like can you scale the strategy down to 100K checks, right? You probably can, right? And so think about like what's the absolute minimum that you can raise, and it's usually a lot smaller than people think. Like funds can work with really, really small amounts, if you don't want to lead or things like that. So think about that. And then, the strategy I would advise is to do a first close that is at your minimum viable fund size. So like worst case scenario, the fund will still work with just that. And if
Mhm.
you raise more, that's better. That's great. You can, get more capital, but it'll still work with just that. So like at a minimum, even if you never raise again, you can still like make the fund work.
Mhm.
And then, you can write smaller checks in the beginning just to be safe, and then
Mhm.
write bigger checks as you raise more or use it more for reserves, things like that. So there's different ways to go about it. But yeah, I think it's very dangerous to assume you're going to, raise a certain fund size, do a really small first close, and then write big checks right away, right? It's much easier to write, or it's much safer to write smaller checks first.
Mm.
Mhm.
I guess so. One of the I think like one so since your fund strategy is to uncover the basically overlooked portfolios, and I wonder, what's your thought process on like when a lot of, let's say, LP or people, how people judge if someone's portfolio is good is like, are they co-invested by, some of the top funds? Um, like how do you
Mhm.
um kind of like what's your thinking framework around that? Like because people like yeah.
Yeah. Yeah, I have a really blunt answer to that, which is I don't care for me specifically. I know some people do. I know some LPs
Mhm.
do. This is a big like debate in the VC community. I honestly don't care. I never have who my co-investors are. I mean, I want them to be like high quality people, so I'll still
Mhm.
like reference them and talk to them just to make sure I get along with them. But like, I don't care how pedigreed they are. Like, it does not matter to me whether Sequoia or Benchmark is marking up my deals. Like, I could not care less.
Mhm.
I do think like there comes a point in time later on at which you do want to have more branded firms, at a later stage, but it doesn't have to be the seed or series A. And I think there's plenty of time for a company to become consensus later on. Um, so that's not really the game I play. But yeah, there are LPs that do look at that as signal. And I think there's a class of LPs and a class of firms that brand themselves as we're going to get access to the same set of deals that X, Y, and Z venture firms do. It's a little more of a consensus game. So I'm doing something quite different.
Mhm.
But yeah, there are LPs that do look at that and do care about that.
When you're selecting who your LP should be, what's your strategy on LP fund fit?
Hmm. Yeah, this was a big thing for me. So I was pretty and I mean, you can't be as an emerging manager too choosy on, who your LPs are. It's
Mhm.
important to raise, capital. But there definitely have been LPs I've spoken with that um, were indicating interest in committing to the fund, but for a variety of different reasons, they weren't. I didn't think they were a good fit. Whether in terms of chemistry or strategy or things they wanted. So I've turned down quite a few during my journey. I say first and foremost, people who are experienced with venture and have a long-term commitment to it is really important for me. So it like rings a little bit of alarm bells if I hear an LP has never backed a venture fund before, and this is the
Mhm.
first one they're doing. Like that's the warning sign. Versus if they've done it for a long time, that's then and they're going to do it across cycles. That shows that they're really committed to it. Second, just like how they reference with other funds and what they're like to work with. I think most LPs who are good are it's not too dissimilar from good venture firms, right? They are responsive, they're helpful when you need them to be, but they're not
Mhm.
overbearing. Like they're not trying to be too prescriptive on what you should do. Um, and then on the recommitment side, that's also important for me, where not necessarily thinking certainly don't think any VC deserves an automatic re-up, but LPs that have a history of recommitting and have a disciplined process by which they do that and do it with regularity is pretty important too, so you can get more stability. So I'd say those were like the main things, and then there's like little things around terms, right? Like I don't give special terms to any LPs, so that's kind of a no-go for me. So people who want special economics or things like that, that's I don't deal with that. So there's some little stuff there, but I'd say otherwise it's more just commitment to venture and demonstrated commitment to venture.
Mm. Since Goodwater in the past, you guys are investing in consumer related companies, and now I saw many of your portfolios are more towards I like yeah, like so basically there's like yeah, I guess like it's not non I consider them non-consumer companies or
Yeah, I
yeah.
do a lot of
I
like
wonder
prosumer and SMB. That's right.
yeah, yeah, yeah.
Mhm.
So I wonder like how do you um I guess like what are things that you feel like are um could be like replicated into your own fund, and what are things that you are trying to re-innovate
Mhm.
in terms of building up your own fund. And hi Sophie, so what are and like how do you kind of shape your strategy going forward?
Yeah. Yeah, so I have a slightly more expansive definition of consumer, where it's not just strictly, like pure consumer, like social and gaming and
Mhm.
e-commerce. I consider workplace tools that are bottoms up driven and individual end user adopted to be
Mhm.
consumer-esque. So I look at a
Mhm.
lot of like there's this theme around consumerization of the enterprise. So that's a big theme I'm looking at and actively investing in. So, tools that help individuals or small teams be more productive or automate different tasks. This intersects really well with AI too. So, like, there's
Mhm.
one company I backed called Browse.ai that helps companies automatically grab and scrape data from any website, and it's a very lightweight, tool that's no
Mhm.
code. So that's an example of a prosumer tool. There are a few I'm looking at now that are more on the creator side, helping
Mhm.
creators do video editing or splicing or clipping or things like that. So that's an
If you
interesting
invest in
space.
any, tell me.
TBD,
I need
TBD.
them.
But yeah, so I really like that intersection of like consumer type of companies. You can evaluate them like a consumer business, right? By active usage, by organic growth, engagement, retention, those kinds of things. Not so much traditional SaaS metrics, but more consumer metrics. And you can find those through data. So I like that space a lot, where it's technically B2B, but they look and feel like consumer companies.
How do you like how would you shape your fund? Because I believe Goodwater hired a lot of people from with a data engineering background, and like do you envision your own fund similar to that, or like are you trying to just be a solo GP for life?
Mhm. Yeah, definitely not a solo GP for life. So, I mean, I don't. I don't aspire to be multi-stage, so I don't, feel like I need to have a big team or a tremendous fund over time. Like I'm not really that interested in doing growth investing. I also think it's
Mhm,
very, very difficult to have alpha and growth
mhm,
at this point, especially with data. And want to be really early stage focused. So from that perspective, I probably won't ever be like a huge team. But I do want to build a small partnership. So, the ideal would be to, hire a couple folks maybe that are mid-level, train them in this system, and then hopefully promote them over time with the hope and aspiration that they become equal partners in the firm. And that's what I would
mhm,
want to do. It'll take some time. It's not going to happen overnight, but
mhm.
in the long run, I do want to build a partnership and have peers that are complementary to me, that help me be better, and that can push the firm forward. So looking forward to doing that.
Amazing. Okay, we have a 1-minute fire round for you. First
Okay.
question: what's your favorite book?
It changes a lot. My favorite book, if I were to think of one of all time, actually, there's one that I really like right now. It's called Poor Charlie's Almanac. So
Mhm,
it's a series of, it's not really a book, it's like a collection of writings of Charlie Munger. So
mhm,
like different speeches he's given and kind of essays he's written about over the years. I just love the man and respect his life a huge deal. He's a very different kind of investor than a VC, like
mhm,
his style of investing, value investing. But I learn a lot and think he had a really good outlook on life.
mm. Who would you invite to your dinner party?
Who would I invite to a dinner party? Do they have to be living, or could they be living or dead?
It's your party.
Currently living, here's a little bit of a cliche answer. Barack Obama,
Mm.
because I really like, I
He's a
feel like he was,
popular guest on
yeah,
some
he
people.
is, but he is a trailblazer in a lot of ways, and he's doing
Mhm,
some tech related stuff now too. So I'd love to ask him
mm.
about that. Historically, I would like to speak with probably Julius Caesar.
Mm.
Julius Caesar, yeah.
Who made the biggest impact in your career?
Yeah. It hasn't been just one person. If I had to name kind of the most impactful, Tomas Tungas from Redpoint, who's now started his own fund called Theory. He helped me break into venture. He was the first person I spoke with at Redpoint. And what I loved about him is he didn't fit the mold of what I thought of as a traditional VC. Like he was kind of like me. He was an engineer, he was really technical, a little nerdy, but he just like is such a great person, super smart, really nice, like just such a nice person. And it's been really helpful to me and helped shape my career. And he helped me break in. So I owe him a lot and really think highly of him.
Mm. Where can we find you outside of work?
Well, I have 2 young kids at home, so they keep me really
Mhm,
busy on the weekends at different parks and things. Um, Outside of that, I'm a big runner, so I've been trying to do some, not yet full marathon, but half marathon training.
mhm,
So I don't like any kind of like different hill running around the Bay Area, in the Marin area. I live in the East Bay, so I do a lot of just running along the Berkeley Hills and
mm.
things like that. So
Amazing. Well, thank you so much, Ed, for coming on the show today.
thank you, Grace. This was a lot of fun. Thank you for having me on.
Okay, let me